Blue Owl experiencing elevated redemption requests for two of its private credit funds in the first quarter, according to letters to shareholders that came out this morning. The firm's flagship OCIC, with about $36 billion in assets, received redemption requests of about 21.9% of shares outstanding during the first quarter. Blue Owl's smaller tech-oriented fund, known as OTIC, received redemption requests of 40.7% during the same period. Blue Owl attributes this to, quote, heightened market concerns around AI-related disruption to software companies. In both of these funds, Blue Owl opted to cap these requests at 5%, meaning in OCIC, investors could redeem about 1/4 of what they wanted, and in OTIC, it was about 1/8 of what they wanted. Blue Owl, which is unique actually in having two of these non-traded private credit funds, is also among the last to report redemptions. The firm's percentage of redemptions is multiples higher than their peers. Most firms have opted to use that same 5% cap, but some, including Cliffwater and Blackstone, allowed slightly more redemptions during the first quarter. Blue Owl's OTIC Technology Fund saw redemption requests of 17% in the prior quarter, in the fourth quarter, which it did fulfill. OCIC's requests were 5% during that period. And these are also two of the funds that hedge funds Saba and Cox have offered tender offers to locked up holders at a steep discount. Also worth noting, guys, that both funds saw gross inflows, which combined with the 5% gates meant that net outflows were somewhat modest, and this is actually what matters for the firm's revenue. The stock, though, for the parent company, OWL is the ticker, that's down more than 6% this morning, down by 42% this year, guys.
Wow.
Those are some big redemption requests.
Certainly are. All right, Leslie, thanks. We're going to do that ourselves. We said no. Let's Leslie.
Leslie, one question on that: the firms that are offering to buy out the investors at the two Blue Owl funds that aren't going to be able to redeem, is that a common practice, or does that tell you if you've got the patience and the money, maybe they see long-term value in holding on to those positions?
You're exactly right, Becky. So Saba and Cox, I talked to Boaz Weinstein a couple of weeks ago about this very dynamic. They see a lot of opportunity here. They're offering basically a 30% discount to tender investors who are facing this illiquidity pinch. And they actually like Owl for the long run. They're long a little bit of the equity, at least they were a couple weeks ago when I talked to them. And they kind of see this more as a byproduct of essentially a gap between what's going on in sentiment and performance, and an opportunity for them to offer liquidity for investors who may not want to see it through, until they can ultimately get whatever money back that they'd like to.
So if you're a retail investor, you get fleeced coming and going on that because you thought this was a liquid asset that is liquid, not liquid a lot of the times when you may want it or need it.
Exactly. It's definitely a learning lesson. I mean, it's in the fund documents. Every fund document has that 5% cap. It's something I think when these funds were structured, I don't know how many managers anticipated just the level and the scale of the emotion that we're currently seeing with regard to the redemption requests and the difficult decision making involved in whether to restrict redemption requests, restrict them a lot, or to take steps, as we saw with Blackstone, where they were able to raise it to 7% and then put in the firm's own capital and employee capital in order to fulfill all of the requests.
The question is if you just were able to leave it there, if you could ride this out, and there is value, and it sounds like certainly some of the professionals believe that's the case. Leslie,
exactly.
Thank you.
Yeah, and that's what they say in the Blue Owl letter, too. They basically say, we see a lot of opportunity in the market. We've seen this in a few of these letters, basically, because spreads are widening as a result of all of this turmoil and concern. And so if you are a private credit manager, that could be a good opportunity if you have the liquidity to put into place. And so if you are to fulfill all the redemption requests, you may not have the same liquidity profile to be opportunistic if you do see various potential in the market environment. And so that's another part of the rub as well.
Yeah, you can't do it if 40% of your funds are gone. You can't be opportunistic.
Exactly. Yeah, you definitely cannot.